Yeah, if anything, I'm more bullish than ever. I think first quarter will be a very strong quarter for stocks. Obviously, I don't know exactly when we're going to hit that target from here. It's over 40%. It's a hefty run. Could happen in, as I say, the last part of this run is going to be parabolic. So it could happen in a matter of just, 2 or 3 months, or it might take a little more than that. But either way, I think, first part of next year is going to be very strong. Same thing with the NASDAQ. I raised my target there from 30,000 to 32,000. I raised my target on the Dow from 60,000 to 65,000. And on the Russell, which I think is going to lead the way in this last run to the top, I raised my target from, I think, 3,400 to 3,800, which is well over 50% from here, I think. So you're looking at, a very unusual, maybe unprecedented rally. What I keep saying, it's the end of a 43-year secular bull market, and at the end, you usually get, some fireworks, and that's what I'm expecting. So people kind of look at those numbers and go, the economy's slowing. Rates are sticky, inflation's sticky. How can you be so bullish? Well, I expect over the course of the next several months for rates to come down and come down quite nicely, for inflation to continue to trend lower, for the economy to hang in there long enough to make it look like there's no recession coming, or at least anything's going to be a soft landing. So I think there's plenty of room for investors to kind of abandon their skepticism. They've been fighting this thing for 3.5 years, and obviously they're invested, but they're cautiously invested or skeptically invested. And even now, you hear people talking about how much more can it go. It's, valuations are high, although earnings might be better. Multiples are at kind of the historic highs. So there's still a lot of skepticism in the market. And that is what I call the fuel for the final advance, the wall of worry that I think will keep fueling this thing. So I'm bullish for sure. And I think it's an opportunity to get on board if you aren't already on board. I think gold and particularly silver look excellent here. I am as bullish as I am on equities. I'm more bullish on the metals, or certainly on silver. Silver, to me, is just breaking out. It went to all-time new highs in the last month. And, my target on silver was raised in that same fourth quarter letter from $75 to $100. And I think we'll be there, could be in the next 4, 5, 6 months. And gold, I think I was at 4,000, raised it to 5,000. That one, I think, is conservative. It could push right through 5,000 given where it is. So both the metals look really good. The miners look really good. My GDX target was raised from 75 to 120. My GDXJ, which is Junior Miners ETF, was raised from 100 to 170. SIL is the large cap silver miners. I raised that from 75 to 150. My junior miners, SILJ, I raised my target from 35 to 60. And like I said, those are pre-bust targets. I'm calling for a bust sometime next year, but prior to that, I expect those targets to be reached. So, you look at the numbers on those, do the calculus on those, and you see that there's an awful lot of upside if I'm right. So I think we're in the sweet spot for the miners. Obviously, the metal price moves up and the miners make more money, and that's where we're at. And surprisingly, institutions are just beginning to warm up to the precious metals. They may have some gold, they have absolutely no silver. That's just happening now, where they're starting to notice the performance and say, well, we maybe need to have a little bit of that in there. So whether it be the metals or the miners, the institutions really haven't been big participants. And I think that could be part of the impetus for those big moves. Yeah, I think the leadership this cycle hasn't changed. We're going through a pretty good consolidation in tech right now, particularly the Mag 7, which had been so over-owned and popular. There's a lot of people saying that's behind us, and I do think, as I said, the small caps might outperform that into the top. But I still expect semis to do very well. I still expect most of the Mag 7 to do very well, and tech in general to do very well, AI to, pick up again. So the leadership will not change until we go into the bust. And then I think coming out, there'll be new leadership next cycle. But I still expect good things for tech and semis. I also think financials will play very well in this last run to the top. They've been a little little bit slow here for, the last month. So people are getting a little bit soured on them. I'll tell you, the picture I see is that they are putting in very high level consolidations, not far off their tops, and they're ready to run again once we have this pullback. So I think financials will play, industrials will continue to play into the top. I think the basic industry, materials should do well into the top, which includes copper. Copper looks very good here, I think. And even things that are interest sensitive that have been hit, like housing, I think the home builders look like they have one last leg to go. That may be hard for people to understand because they've disappointed here for, last several months, and they look like they're done. But I think they're building a rounding bottom here, and I think are going to go on to new highs. It will be driven by lower rates. I'm very bullish on the bond market here. Short term, I see the potential for, the setup there for the 10-year to go from back up to, say, 4.25, 4.30. So that might be the impetus for the pullback in the equity market. If the equity market drops 4%, it's probably because the bond market's selling off. I see maybe in the first quarter, certainly by the second quarter, you could see 3% or below on the 10-year. And if you get that, obviously that will help mortgage rates, and it'll be going into a spring selling season. So you could get one final hurrah in housing, not to new highs for homes themselves, home prices and activity, but for the home builders, they could get, a surge in activity and run their stocks up. So I do think home builders will play here, and, anything else in the financial area will benefit by lower rates. So, banks look very good, stockbrokers look good, and other than that, the area that has caught everybody's attention recently is healthcare and biotech. If rates come down, that's going to benefit biotech for sure. I think the market's going to broaden out, so an awful lot of things are going to play in this last run. The things I'm not bullish on, the things that I would not expect to play out very well are energy. The oil, I still think oil's going lower. Not necessarily, be in a trading range for a while, but in the bust, I expect oil to go to $30. So there's still plenty of downside in oil. And, the energy area is just not an area where I would be expecting much. Utilities will play if bonds play, but they're typically not going to deliver the kind of returns you're going to get from tech or industrials or financials. I've had a lot of people ask the question of, could that change your forecast? Could that stretch out the cycle or even eliminate the bust? And I remind them it's a global bust, first of all, so it's not just U.S. centric. And number two, the reason I'm calling for a global bust is because of excesses that have built up over decades. It's not just, the last couple of years. So it could prolong things for weeks or a month or two, but I don't think it changes the ultimate outcome. I still think we're heading for something pretty dire, simply because you've got far more leverage today than you had in 2008-9, and there are issues out there that it's not just U.S., it's around the world. The economies are not in great shape. Even the U.S., if you look, it's a have and have not economy. So you've got the people at the top end have plenty of wealth and have plenty of money to spend, and they're kind of keeping things going. The people in the bottom half are just trying to make ends meet. And the other part is just as we go forward, there are signs that more and more people are becoming constrained. The debt numbers, the delinquencies, etc., are starting to show signs. They're still not at the point where you get really nervous, but they are showing signs that this economy is late in the game, and the typical strains that show up just before a recession are showing up. Yeah, we can stretch things a bit with a $2,000 tax cut or whatever they're going to do, tax credit, but I just don't think it changes the major picture. The thing I would just remind people is that this is the end of a long cycle. So yes, we're in for some fireworks if I'm right, and it's going to be, I think, the biggest rally in history perhaps coming up. However, just remember, it's the end of a 43-year secular bull market, and what follows is probably going to be the biggest bear market since 1929, again, if I'm right. So don't get caught up in because it's investor psychology works opposite to what's productive for an investor. It means that you get caught up in the tape, you get caught up in the momentum, and you become more bullish at the top instead of more bullish at the bottom. I just caution people to know that's how it works. And when everybody's getting more bullish and calling for this thing to, go for another year or two or three, be careful, because just remember where we came from. We were at 3,500 on the S&P, back in October 2022. So we're, say, 3.5 years from now, we could be 2.5 times where we were back then. That's a big run, and I just want people to know that. The other thing I should say say is for those that have financial advisors or at least pay attention to what is kind of the mantra out there, which is buy and hold. This is the one time if we're looking at, again, I can be wrong, but if we're looking at a bear market that's the biggest in my lifetime, biggest in the post-World War II era, biggest since 1929, buy and hold means you're going to ride it all the way back down. I'm calling for an 80% drop in the indexes. You ride it down 80%, that means you could even triple or quadruple off the bottom and not get back to the levels that we're going to see early next year. So I just would tell people there are times when buy and hold works great. In the last 40 years, it has. If anybody listened to financial advisors starting in the mid 80s when they started saying, the popular mantra was it's time in the market, not timing the market, meaning buy and hold, just ride through the corrections, the bear markets, etc., and you'll do well. That was great advice. Anybody that bought the S&P index in 1985 is sitting very pretty today thanks to that advice. However, times change, and we are heading into a very different environment where buy and hold could be a real penalizing strategy. So, the industry is not going to change. The financial industry is going to stay with what brung them there. They're going to continue with the buy and hold strategy. But I'm just saying for people to think about this and understand what the implications are if my forecast is right. It means you ride it all the way down and you may never get back to the levels of your valuations that you have, today, or certainly, in the first quarter. So it might make sense to look at things that will hold up in the bust and switch your portfolios around from, all equity or heavily equity to treasuries. Treasuries will be one of the very few assets. If I'm right, rates are going to drop below 3 in the next 3 to 6 months and probably head towards 0 in the bust. And if we go to, my forecast is a 0% 10-year, the end of next year probably, or early 2027 at the bottom, at the end of the bust. If that happens, bonds do very well while everything else is getting hit very hard. So it's not like you have to go to cash. There are other alternatives. So I just thought for people to kind of ponder, because, if this happens, you're going to get excited. People are going to see, the news is going to be talking about it. Everybody's going to be telling you about how this is the great new world and this is going to go on for a long time thanks to AI, thanks to robotics, thanks to a lot of things, thanks to maybe peace in the Middle East and peace in Ukraine. Who knows? There could be a lot of things that will convince you that the next few years is going to be great and you're going to have a hard time selling. Just remember this to kind of be as a kind of in the back of your head as a conscience to say, yeah, I hear all that, but here's the other alternative.